I've been through three silver bull markets. The first one was a 30 bagger, and the next two were each 10 baggers. Do I really care if it takes 2 years to get there? Now, in terms of what we're seeing in the last week, from my viewpoint, this is all staccato. This is all noise. In a different prior interview, when you and I were together, you were mentioning some of your listeners, probably younger listeners, concern about would the gold price ever get through 2000? I don't know if you remember this. And I remember saying to you, Chris, a $200 gold move in gold is of no interest to me. I couldn't care less. I own gold not because I think it's going to go through 2000, but because I'm afraid it's going to go through 8 or 9,000. And I feel the same about the price action that we've seen in silver. I don't think we're seeing a silver breakout yet. In my experience, precious metals bull markets are led by gold. Then the money moves to the gold stocks. And then when that price momentum attracts the generalist investors, which it only has for the last 13 or 14 weeks, eventually leadership goes to silver. When leadership goes to silver, you're not going to need some old fat bald guy, Rick Rule, to tell you that leadership has transitioned. I've watched three silver bull markets in my life, and they are nothing if not dramatic. You won't be talking about a move from 34 to 36 or 7 and back. You're not going to be talking about dollar moves. You're going to be talking about lock limit up. So let's get that one straight. Yeah, people are interested in dollar moves. They're interested in intraday moving averages and stuff like that, I think to amuse themselves. I'm interested in quantum moves, which require more time. No, I think for the balance of my life that the US dollar will be the world's reserve currency. For the record, I'm a very healthy 72-year-old, but I think that US hegemony will decline. Which is to say that the dollar's current market share in global transactions will fall from the high 70s to some lower number. What I do believe is that the US dollar as a measure of liquidity will outperform the US Treasury as a store of value. I believe in an absolute sense that, not relative to other fiat currencies, but in an absolute sense, that the US dollar will lose something like 75% of its absolute purchasing power in the next 10 years. We saw this in the decade of the 70s. And I think I can back up arithmetically why that's much more likely to happen. The consequence of that is that although gold will not replace the US dollar, either completely as a store of value and as a medium of exchange, that the increase in the gold price should be at least concomitant or proportional to the decrease in the purchasing power of the US dollar. For gold bugs to be happy, you don't need the obliteration of the US dollar, and you're not going to get it. Did you know? I think you probably do, Chris, because you study this. In the most recent estimate by J.P. Morgan Chase, the market share of gold and precious metal securities relative to other asset classes was only 0.5%. Yeah. The 4-decade mean was 2%. And according to J.P. Morgan Chase, they admit to not having statistics going back that far, but they estimate in 1981, the sort of nadir of the gold bull market, that the market share of precious metals and precious metals related securities relative to other asset classes was between 6 and 8%. I'm not suggesting that we take out our old high market share, but I'm suggesting that demand reverts to mean. Imagine what happens given that price movements take place in just part of the value chain if we increase demand for precious metals fourfold. That's what I think is going to happen. I'm talking about it in the price of goods and services. Okay. The U.S. government, has managed to confuse the U.S. taxpayer and the U.S. consumer and the U.S. voter by getting you to focus on something called the CPI, colloquially known as the CP lie. If you believe in that, you believe that U.S. inflation, I would define inflation as the deterioration in the purchasing power of the dollar, is progressing along at a nice tepid 2.5%. The problem is that this defies common sense and arithmetic. First of all, Chris, I don't know if you know this, but the CPI doesn't include tax. The idea that there's a cost of living that doesn't include the largest component of one's cost of living is fallacious to begin with. But let's get away from that. Take yourself back to 2020, or have your readers take themselves back to 2020, and look at the period 2020 to 2025. What's happened to energy prices? What's happened to the gasoline price? What's happened to health insurance and health care? What's happened to mortgage interests? What's happened to housing prices? What's happened to rent? The idea that your groceries up 60%. The idea that the purchasing power of your US dollars has declined at 2.5% compounded is hilarious unless you happen to be living on a fixed income, in which case it's treacherous. That's really what I'm talking about. And I'm talking about one more thing, Chris. Gold does well when people are concerned about the maintenance of their purchasing power in US dollars. So think about this. If you are invested in the world's premier savings instrument, the best of the best, the one that everything else is measured against, that's the US 10-year Treasury. If you're getting paid 4.5 in a currency that's declining by 2.5% a year, you're making a 200 basis point or 2% real yield. Not all bad for a riskless asset. If by contrast, you're getting paid 4.5 in a currency where the purchasing power is declining by 7.5%, you're actually losing 3% of your purchasing power every year for 10 years. At the end of that 10-year period, the U.S. government gives you back 60% of the purchasing power that you started out with before you made the investment. A guaranteed loss. That's why gold is doing well. And that's why U.S. dollar savers need to understand the juxtaposition between nominal yields and the declining purchasing power of the dollar. It's critical. I've been through this before, Chris. You're too young. But in the decade of the 70s, the purchasing power of the U.S. dollar declined by 75%. $1,000 in 1980 bought you what $250 would buy you in 1970. Not surprisingly, over that period of time, the gold price increased 30-fold. Now, I'm not suggesting to you that the gold price increases 30-fold from here, because it's already increased 12-fold since the year 2000. But I believe, Chris, that it's likely that the gold price mirrors the decline in the purchasing power of the US dollar. It's a function of your sense of time, Chris. If you're asking me the question around the concept of a silver squeeze, here's the silver squeeze. There is more silver that trades in the futures market by far on a daily basis that is around for good delivery in a quarter. There are some days where the futures market trades 200 times the amount of silver available for good delivery. These things cash settle. It's important to know that. If they don't cash settle, what happens is that the market gets halted, and then the exchange forces a cash settlement at their price. But if you're looking for a place that a silver squeeze takes place, it's in the over-leveraged nature of the futures market.
Yeah.
There are a lot of speculators who require immediate gratification. They carry about a 50-cent move in silver, and they actually believe that there is going to be a physical squeeze in silver that will force the institutions into the market in a big way. That won't happen. The futures exchanges operate in their own interest, in the interest of the dealers. If there is an ugly, ugly, ugly silver squeeze, which I think they could be, they will do what they do with the tin market. They will halt the market and they will cash settle at a level they choose. You mean they'll screw their customers? Of course they will. That doesn't mean that there isn't a boatload of money to be made in the silver business. I've been around this business for a very long time. And a silver bull market is truly a wonderful thing to behold. But don't tell yourself, don't set an artificial timeline. Don't say, oh, for sure it has to happen by Thanksgiving. Why? The silver market doesn't care about your time preference at all. The silver market doesn't care about the stop date, the start date. They don't care. But in my experience, I've been through 3 silver bull markets. The first one was a 30 bagger, and the next 2 were each 10 baggers. Do I really care if it takes 2 years to get there? 3 years to get there? Put any discount you want in terms of the time value of money. Never mind a 10 bagger, a 3 bagger pays you a lot of rent.
Yeah.
And I think it's a probability as opposed to a possibility that we get a silver bull market, a silver breakout.